Welcome tonight. We are very excited to be the sponsor tonight, along with UConn, for the Global Economic Trends Lecture. We have been sponsoring this event for a couple of years, and we always find the topics very relevant, and I'm sure you will tonight as well. Just a little bit about First County Bank. We have been in the community here for over 168 years. We are a mutual community bank, and we pride ourselves in helping individuals, families, and businesses reach their financial goals. So I just want to give a little recognition to my colleagues that are here tonight. If you just want to raise your hand, because hopefully at the reception later you'll get a chance to meet us, and we'd love to talk to you and get to know you a little bit better. So Willard Miley, the president of our First County Bank, is right here up in front, and Nino Antonelli, another colleague, right here. On to the World Affairs Forum, so I have him to thank for getting on board, so thank you, Nino. And Mark Rosenblum, our Director of Cash Management Services. So I also have the distinct honor tonight of introducing Professor English, so just a few words about him. Bill English joined the Yale School of Management in 2016. He had previously been at the Board of Governors of the Federal Reserve System. From 2010 to 2015, he was Director of the Division of Monetary Affairs and Secretary to the Federal Open Market Committee. In that position, Bill oversaw the development of monetary policy, working extensively on issues related to asset purchases, policy normalization, and policy communication. His research has focused on issues related to monetary policy, including unconventional policy and banking issues, which we hope to hear more about tonight. Just a little bit more. Prior to joining the Federal Reserve, Bill taught at the University of Pennsylvania, where he won the Irving Kravis Prize for undergraduate teaching in economics. He received his PhD in economics from MIT and his BA in economics from mathematics at Yale University. Thanks, and welcome.
Glad to be here, and I'm glad all of you could come out. Let me see if I can get up my slides.
Yeah, hit escape.
Yeah. Okay, well, thanks very much, Sarah, and thanks to all of you. We're pleased to be here. What I wanted to do is kind of my starting point, as it were, is that several major central banks have begun or have already completed, in the case of the Bank of Japan, substantial reviews of their monetary policy tools, their monetary policy frameworks. The Bank of Japan did this work in 2013 and 2016. The Federal Reserve announced about a year ago that they were going to undertake such a review. They promised results this coming summer. And the European Central Bank has just recently announced, under their new president, Christine Lagarde, that they're going to conduct a review as well. So I think these reviews are sensible and appropriate. Central banks, in the last downturn, after the crisis, when there was a big recession, found themselves constrained. They were constrained because they couldn't lower rates enough to provide the accommodation that they wanted. They had to take on, instead, a variety of unconventional tools I'll talk about a little bit later to provide additional support to their economies. And now, kind of, in at least relative peacetime, it seems a good time to take stock. So how did those tools work? How do the central banks feel about their preparation for the next downturn? What will they do? How will they use those tools? And are there benefits to making more fundamental changes to their monetary policy frameworks? So that's what I want to talk about this evening. And I'll focus on three questions. First, why have central banks found themselves constrained? Something changed. What is it that changed that left them in the last recession kind of stuck at the lower bound of their usual policy interest rates, unable to use their conventional policy to provide the accommodation they wanted? Second, what are the unconventional tools that we use? How do they work? And how should we think about them as tools going forward? And finally, would broader changes in the policy framework help in the current situation? So let me start with my first question. What's the problem? What happened? The basic problem that central banks face is that interest rates are really low. And this isn't just a cyclical thing, it isn't just that economies are weak, so monetary policy is accommodated. They've been trending down, and they've been trending down for decades. So here's a chart that shows the red line is the 10-year treasury rate, the blue line is the Fed's conventional policy tool, the federal funds rate. And what you see is over 40 years, from 1980 to now, these things have just been trending down. It's most striking, at least to me, looking at the federal funds rate, because you see that it goes up in good times, it falls in recessions. It's the Fed provides accommodation to try to offset the recession, and you see the peaks just fall, and the troughs just trend down and then end at zero from 2008 to 2015. So there's just this long-term secular decline in interest rates. Why is that? I think there are two reasons. To understand and remember that nominal interest rates are the sum of two pieces. One is just inflation. So you invest money, you want to get compensation for inflation so that you get back the same purchasing power that you invested. And then there's any additional return you get is what's called the real interest rate. The extra income that you get in terms of purchasing power for having invested your money for some term. And both of these components, inflation, which I label pi, and the real interest rate, which I label r, have been declining steadily over time. So here's a chart of inflation. Since 1980, inflation has moved down very considerably. So it was up around 10% back around 1980. And then there was a successful disinflation under Paul Volcker and Alan Greenspan. And by, say, the mid-1990s, inflation was down around 2%, and it stayed there ever since. So inflation has come down, and then the real interest rate has also come down. So this is a chart that shows the kind of neutral level of the real interest rate, like kind of the average level that you'd expect going forward over the next several years. And that's the blue line, and it's also just trended down over time. There are a lot of measures of this. This is one produced by Thomas Laubach at the board and John Williams, now the president of the New York Fed, that I stole from the New York Fed website. But all of the measures show a similar decline. These are changes in the environment that the central bank has to live with. So why has the neutral interest rate fallen? Well, there are a bunch of reasons. This would be a separate talk, but there are demographic changes. The population has aged. As people get older, they're not borrowing as much, they're not demanding as much credit, not putting pressure on savings, and so that means interest rates fall. There's just slower productivity growth. We're not innovating as rapidly as we had been. That puts downward pressure on investment demand, and so pushes down interest rates. And there's increased global savings, particularly in Asia, China, and other fast-growing, high-saving Asian countries are a bigger part of the global scene. And so globalization is also pushing down interest rates. The thing to notice about this is it's not likely to reverse anytime soon. So low rates, I think, are a fact of life that central banks will have to live with. But that raises a second question. Why is that such a problem? Low interest rates at some level seem great. Right? Low mortgage rates, you can buy a bigger house. Low auto loan rates, you can buy a bigger car. So why are low rates a problem? The problem is that monetary policy can be constrained. The traditional, conventional monetary policy tool is a short-term nominal interest rate that the central bank controls, like the federal funds rate in the U.S. And as I mentioned earlier, during the financial crisis, the Fed pushed that rate down essentially to zero, and then it didn't cut it any further. There are limits to how low you can take interest rates. So you might ask, well, why can't you just reduce interest rates further? You can reduce policy rates down to zero. Maybe you could reduce them below zero. That's a little weird. You save money at the bank, and at the end of the year they say thank you very much, and they take some of it to pay themselves and give you back less than you put in at the beginning of the year. So that's a negative interest rate, but it seems disappointing for the savers. But one limit on that is currency. Like currency, what is currency? It's basically a government bond that pays zero nominal interest. So people can get zero for sure by holding currency. So if you take rates really far negative, what happens? Well, people and firms and banks will just hold a ton of currency because an interest rate of zero looks good if market interest rates are -2 or something like that. And so that puts a floor under how far you can move rates negative. How far can you go? Well, the Swiss National Bank cut their policy rate to -75 basis points in 2015. This is a chart showing that. It was a surprise at the time. Everybody wanted to watch what's going to happen. Not much happened. There wasn't a huge accumulation of currency. It seemed to work. And other central banks in Europe have followed. The Bank of Japan also has followed. So you can go at least a little bit negative, it turns out. Though when we thought about that at the Fed back in 2010, the committee wasn't that interested. So we wrote a memo to the committee saying, you might want to take rates negative. We think that you could. We looked at costs of storing, transporting, guarding, insuring big bundles of currency, and concluded they could take rates maybe to -30 basis points or -35, something like that. Looks like we were wrong. They could have gone further. But the committee was worried. Their questions were all about, well, how low can you push rates before you cause problems? Cause problems for financial institutions, for financial infrastructures, that could make the lower rates counterproductive. So you get lower rates, but if, for example, that puts pressure on bank profitability and on bank capital, then banks may be less willing to lend. And that is a countervailing force that means that your lower interest rates aren't fully reflected in the economy. And if those countervailing effects are big enough, it's just counterproductive. You don't want to cut rates. And so there's been discussion by economists of what's called the reversal rate, the rate at which lower rates no longer are more expansionary. They're actually contractionary. They put pressure on financial institutions and markets. So the Fed was worried about that. And so quite formally, quite expressly, they decided, nah, we're not going to try to do that. We're going to go with unconventional policy instead that fall. The second big asset purchase program that they put in place, so the 4 they put in place during the post-crisis period. Somewhat surprisingly, at least to me, the Fed continues to kind of rule out negative rates. They've said they don't want to use negative rates. Given that other central banks have done it, hasn't appeared to break things in a serious way. Would have thought maybe they'd be a little bit tempted by at least a little bit negative rates, but seemingly not the case. So this lower bound on interest rates, whatever it is, whether it's zero or a bit negative, I think is likely to continue to be a constraint on conventional monetary policy in the future. In the period since 1960, if you just go back and look at recessions, the Federal Reserve has generally cut rates in recessions by 5 or a little more, 6 percentage points. And so if the neutral level of the nominal federal funds rate is only 2 or 3%, at R star, that real neutral rate is 0.5%, maybe 1%, inflation's around 2%. So the federal funds rate is likely to be kind of 2 or 3% at the outbreak of the next recession, maybe lower. I mean, today, the federal funds rate's between 1.5 and 1.75%. So the Fed's not going to be able to cut 5 or 6 percentage points when the next recession comes. So they're likely to find themselves back at the zero bound, and they'll have to again turn to unconventional tools. And so as part of their review, presumably they're going to say, in the next downturn, we're going to have to use unconventional policy again. And that takes me to my second question, which is, what are the unconventional tools that central banks have used, and how well have they worked? What do we know about how effective those policies were? So in the United States, the use of unconventional policy focused on two tools. One is basically talking, communication by the central bank about its future intentions regarding interest rates. And in particular, providing words suggesting that you're not going to raise rates anytime soon. And the second tool is purchases of longer-term assets, large-scale asset purchases. So both of these were aimed at easing financial conditions by reducing longer-term interest rates. So you push short-term rates to zero, and then you want to push down longer-term rates. Mortgage rates matter for spending. Auto loan rates matter for spending. So you want to push down those longer-term rates. And the way you do that is using forward guidance and asset purchases. So to see how that works, let's start by reminding ourselves that long-term interest rates can be thought of as average short-term rates over the life of the longer-term rate, plus a risk premium. So think of an investor who's going to invest money for 5 years. The investor could just go buy a 5-year treasury note. The investor could also go and buy a 3-month treasury bill, and then in 3 months roll it over into another 3-month treasury bill, and then again and again and again to the end of the 5-year period. So there are two investment strategies. One's going to give you the long-term interest rate. One's going to give you the average short-term rate over those 5 years. And probably if you're an investor, you're thinking, well, putting my money into a security for 5 years is riskier, so I want some sort of risk premium that I'll call the term premium. And in the past, that's generally been positive. You get a little extra if you invest for the long term than if you just roll over short-term investments. This is a measure of that term premium that some of my colleagues at the board have produced. So now, with that as background, we can think about how does forward guidance work? Well, you're using communication to reduce expectations for future short-term rates. You do that by saying things like, as the Fed did in August of 2011, the committee, that is the Federal Open Market Committee, the monetary policy making body of the Fed, currently anticipates that economic conditions are likely to warrant exceptionally low levels for the federal funds rate, at least through mid-2013. So they're saying for 2 years, we don't think we're going to be raising rates. And that pushed down market expectations. Market expectations had been that they'd raise rates sooner than that. And so that pushed down the path of expected future short rates. That cuts this first component of long-term rates, the average of short-term rates over that long period. And so reduced long-term interest rates. The second thing the Fed did was large-scale asset purchases. And this is basically a story about supply and demand for longer-term securities. So the Fed goes out and buys a whole lot of longer-term securities. As long as the demand for those securities is a function of the return on them, then as the Fed buys more and more of those securities in markets, it's going to push up their price, push down the yield on those securities. So long-term rates fall. The expected future path of short-term rates hasn't changed. And so the term premium has been compressed. And that chart I showed earlier of term premiums has indeed come down a lot lately, and that partly is the result of these asset purchases. Now, given the size of U.S. financial markets, the Treasury and agency security markets at the time of the purchases was about $20 trillion. Total fixed income markets far, far bigger than that. So you're going to have to buy a lot to have an effect on these long-term rates. And the Fed did. This is the size of the Fed's balance sheet pre-crisis, less than $1 trillion. Post-crisis, $4.5 trillion. So the Fed went out and bought a hell of a lot of longer-term securities, and that put some upward pressure on prices, downward pressure on yields on those longer-term securities. So I've suggested how these policies could work, these unconventional policies, but did they actually work? Well, there's a fair amount of evidence summarized nicely in the recent speech by Ben Bernanke, who gave his presidential address to the American Economic Association a month ago. And he kind of goes through all of that evidence and concludes that yes, you get some fairly significant effects of these things. So It's pretty clear that forward guidance moved policy expectations. Longer-term interest rates fell. Stock prices rose. Lower interest rates boosted stock prices. And announcements of asset purchases similarly pushed longer-term rates lower and boosted stock prices. So I stole a couple of tables from the speech. So here's one. This is the effect of the first two significant forward guidance announcements. So the Fed said, we're not raising rates for 2 years. And then a while later, they said, well, I'll make that 3. Pushed back to even further. And the effect of those two collectively was the 10-year Treasury yield fell by about 27 basis points, about a quarter of a percentage point. Stock prices went up by about 5, maybe 6%. So pretty significant effects in asset markets of the forward guidance. This is a table showing the responses of asset prices to the 3 announcements that were made among the first of the big large-scale asset purchase programs. And here the effects are even larger on yields. The 10-year Treasury yield fell by 100 basis points. Mortgage-backed securities agency, mortgage-backed securities yield fell 129 basis points, more than a percentage point. It's not that surprising, but that's bigger than the Treasury effect because a lot of those first purchases, the first round purchases, were in mortgage-backed securities. So the effects were bigger there. You got a positive effect on stock prices as well. So again, pretty big effects of these unconventional tools on longer-term interest rates and on asset prices more broadly that should help to boost the economy. Now, these policies also involve risks and uncertainties. So the policymakers at the Fed were thinking about a trade-off, doing these additional actions, these unconventional policy actions, but balancing the benefits against potential costs and risks associated with those policies. So one cost or risk that some observers were worried about, I think wrongly, was that the policies could result in very high inflation. It could lead to skyrocketing inflation, a collapse in the foreign exchange value of the dollar, and things like that. I think that was always an overblown concern because if the policies were really effective, then you do less of them. You don't have to do a huge easing action. If the policy works, you do the amount that you want, and you don't have to do a whole lot more. So I think you could avoid terrible outcomes where the economy overheats and you get a huge amount of inflation. But the other two issues are a little bit more significant, and that is that the two unconventional policies first might make it hard to raise rates when the time came, and second, that they might encourage excessive risk taking, and so undermine financial stability. You can worry that you'd end up with another financial crisis because of these policies. And so the Fed worried about these things. They took normalization risks pretty seriously. I was on the staff at that point. I just checked the other day to see. In April of 2009, so the first purchase program, the announcement of it was only in March of 2009. There were actually 3 announcements over time. So the next month, at the FOMC meeting, the FOMC members were saying to the staff, "You've got to come back with a plan for how are we going to raise rates when the time comes to raise rates? How are we going to exit from this? How are we going to shrink the balance sheet when the time comes?" And the staff did. We produced a bunch of memos, and the world's longest briefing. I think there were about 8 briefers or something at the June meeting, laying out a lot of stuff about how they could exit. So they really wanted to know, before they got too far in to these purchases in particular, that they could get out. That if it came time to raise rates, they'd be able to raise rates. That was important. And so the staff did a lot of work on that. In the end, they published exit principles in 2011, and then pretty detailed plans in 2014 with various updates since. And in the end, normalization has gone pretty smoothly. There's been some learning along the way, there's been some glitches, but they've been pretty simple. So that risk turned out to be not that big a risk, and was dealt with pretty rapidly. The second risk that people worried about is the financial stability risks. So the concern here was you have very low interest rates. You said that rates are going to stay low for a very long time. And that may encourage investors to do what's called reaching for yield. So investors may take on risks that they don't really understand very well in hopes of getting a higher return on their investments. And then some shock happens, and they say, gee, I didn't realize I was that much at risk. And they have big losses, you have big problems, you have financial firms on the brink, and you're back in the soup where we were in 2008, 2009. So the Fed worried a lot about that. The staff did a lot of work on monitoring risks. Are there indications that banks, insurance companies, others are reaching for yield? How worried should you be about that? What exactly is going on? Lots of conversations with supervisors about regulated firms to get better information about what was going on. But in the end, the committee basically said, we can reduce our purchases if we need to, if we think that there is significant financial stability risks. But they never concluded that they needed to, so they continued the purchases more or less to achieve their macroeconomic objectives. So two risks that the committee worried a lot about and addressed, and in the end decided they were comfortable with. But they had to balance those risks and costs against the benefits, and the benefits they thought were pretty big. So this is a model, the FRB US model, the big macro model that the Federal Reserve Board. My colleagues Eric Engen and Tom Stahl and Dave Reitschneider wrote a paper where they tried to roll up all of the effects of both forward guidance and asset purchases, so all of the unconventional policies, and figure out how big were the macroeconomic effects of those policies. And these are they're either large or small, kind of depending on what you expect from going in. What they found was the biggest effect on the unemployment rate was a reduction in unemployment of about 1.25%. And the biggest effect on inflation was a positive effect of about less than 0.5%. So how big are those? Well, they're big enough to be worth having. As Ben Bernanke used to like saying, the effects are significant, but it's not a panacea. Didn't make the crisis go away, didn't make the recession go away, but made it less bad. 1.25% of the unemployment rate is like 1.5 million people who weren't unemployed as a result of these policies. That's pretty substantial. How big are these effects relative to kind of ones that we understand better, conventional policy rate cuts? Well, the model suggests that the unconventional policy in the U.S. was worth more than 300 basis points of conventional rate cuts, maybe like 350 or something like that. So again, a significant effect, but not a panacea. And the committee would have liked to have provided, I don't know, another 600 or more basis points of easing. So they got a big chunk of that, but not all of it. And the largest effects came late, right? If you look at these charts. The peak effects are in 2014, 2015. So, well, it's basically because the committee moved cautiously. Their initial forward guidance wasn't very robust. Their initial asset purchases, while big, were not that big compared to a $40 trillion fixed income market. And so the policies were strengthened over time. Monetary policy works with a lag. So the biggest effects of the monetary policy actually came kind of late. That's something that I think central banks have to think about as they conduct these reviews of their framework and their policy tools. That said, as Ben Bernanke said, as Ben Bernanke said in his speech at the AA meeting, these effects are large enough that, given that you want to ease, say, 500 or 600 basis points equivalent in a recession, that you can get there in the current environment. The neutral federal funds rate is around 2 or 3%, we think. So in the next downturn, you can ease conventionally, maybe 250 basis points of easing. And then you can do unconventional policy like last time, and that's worth 300, 350 basis points of easing. So cumulatively, you can put in place the 5 or 6% of easing that the Fed has put in place in past downturns. So that's good news, but I think it's a little tricky. You shouldn't be too centered here because it won't be enough, for sure, if there's another really big recession. Even if you amped up the purchase program, even if you amped up the forward guidance, you're not going to be able to address a really big recession like the 2007-9 recession. And the neutral level of interest rates could continue to fall. It's been falling for 40 years. And if it continues to trend down, 10 years from now, we have a bigger problem because interest rates are going to be even lower than they are today. So we're thinking a little bit about what else could be done. Other central banks used other unconventional tools. In addition to purchases, in addition to forward guidance, basically all the advanced economy central banks were doing for a time, they considered 3 other things. They targeted long-term interest rates explicitly. They purchased a broader range of assets, and they took steps to encourage bank lending. On targeting long-term interest rates, the example here is the Bank of Japan. So back in 2016, they announced their qualitative and quantitative monetary easing with yield curve control program. What that meant was they were going to buy a lot of government securities, and they also announced that they were going to effectively fix the 10-year government bond yield in Japan at about 0. So they weren't just going to buy some dollar amount of government securities. They were going to fix the rate. Right? In some sense, you can set a price or a quantity, right, in the supply and demand graph. They were saying, we're going to set a price. We're not going to set a quantity. And that was quite powerful. On the other hand, it made me exit pretty hard because when people think, well, they might raise that rate on 10-year government bonds, then they don't want to hold 10-year government bonds. They want to sell them to the Bank of Japan. So the Bank of Japan could end up holding all of the 10-year GGBs if they're not careful. So they've got to think hard about how they're going to exit from that. On purchases of other assets, the Federal Reserve is quite constrained by the Federal Reserve Act. Section 14 of the Federal Reserve Act says basically the Fed can buy Treasury securities and government agency debt securities. So we couldn't buy other assets, but they could be useful in providing stimulus to the economy. And the ECB and the Bank of England, for example, both purchased corporate bonds and private corporate bonds. The Fed didn't do that because we couldn't. The Bank of Japan has purchased corporate bonds. They've also purchased equities through exchange-traded funds. They've also purchased Japanese real estate through REITs. So they've really cast a wider net on the assets that they'll buy. And finally, the programs to encourage bank lending. A bunch of central banks, the ECB, the Bank of Japan, the Bank of England, all put in place programs under which, in effect, if you're a bank and you lend more, you increase your lending to households and businesses in the country, then you get cheap financing from the central bank to fund that lending. So it's really a subsidy to encourage lending to the private sector in their countries. So those are all things that other countries have tried. These additional unconventional policies seem to have helped in those countries. So if you talk to central bankers, they say, yeah, we use financial conditions, help support growth. They also, though, involve much larger interventions in financial markets. And really, particularly in the case of that last one, a move into the fiscal arena. You're really providing a subsidy for lending. That's something that, in this country at least, seems like something Congress should do, not the central bank. And so the Fed looked at these things, we talked about them, we sent memos to the committee about them, but in the end the Fed decided not to take these steps. They stuck with, if you like, conventional, unconventional policies, and not these additional, very unconventional policies. But that brings me to my third question, which is, would broader changes in the monetary policy framework help in this situation? So first thing you want to know is, what the hell do I mean by monetary policy framework? So what I have in mind for the monetary policy framework is the broad approach that the policymakers take in judging what's appropriate monetary policy. So in the United States and in most other advanced economies, that's a thing called flexible inflation targeting. So the central bank is aiming to achieve inflation, generally the goal is 2%, out in about a few years. And in the meanwhile, they're trying to support output and employment to the extent possible, given they have to achieve that inflation goal out in the future. That supporting output in the meanwhile is the flexible inflation targeting part, taking into account the effects of monetary policy on output and employment. So here's an obvious possibility. Just pick a higher inflation target. For example, Olivier Blanchard, former chief economist at the IMF, has said, raise your inflation target to 4%. You think that the equilibrium real rate is around 0.5% or 1%. It's the R-star chart I showed you earlier. Add 4% inflation to that, that gets you near 5%. If you think you can go a little bit negative, you can get the 5.5% easing that the Fed has undertaken in past recessions without messing with unconventional policy at all. And that may be attractive to some. But I think there are a bunch of problems with this. One is, it may just be hard to deliver. You may fail. The Bank of Japan in 2013 said, our inflation target is 1%, it's 2. They haven't seen 2 yet. It's very hard when inflation expectations are well anchored. People have gotten used to there not being a lot of inflation, as they have in Japan, to get inflation up to a new target. So one problem is you may fail. The other is you may succeed. Higher inflation has costs. Higher inflation causes a lot of inefficiency in the financial sector, in the tax system. There are a lot of reasons to worry about achieving higher inflation, and you may not think those costs are worth it, given that you have unconventional policy that you could use instead. And the transition may be really tough. So you announce at some point, well, we don't like our old inflation target of 2, we want to have inflation be up around 4. The public could say, gee, they say 4 now, but maybe they'll say 6 sometime in the future, or 8. Once you've kind of freed up your inflation objective, people won't know quite what to think. So at least for a while, I think you're going to have more volatile inflation expectations. That's not helpful for economic stability. And the final issue is, would the public understand? It's not going to be popular. In their Fed communication meetings with the public that the Fed's been holding, they've tried to explain to the public, people who've come to these meetings, gee, we want to have inflation be a little higher. And the public says, what the hell? I don't want inflation to be higher. That just reduces my income, reduces my standard of living. And the Fed says, well, we don't mean that. We mean your income would go up faster and prices would go up faster. And people say, yeah, sure. So they're not going to thank you, I think, if inflation starts to be around 4 rather than around 2. So that's one possibility. Another possible change, a bigger change, would be to move from an inflation target to a price level target. So in the current regime, the current framework, bygones are bygones. If inflation's been too low for a decade, as it has been, you just lay that aside. You're still aiming to get inflation back to 2 over the medium term. And that doesn't change because you've missed in the past. It might be better to have a make-up strategy, to say, well, if we missed to the low side for a while, maybe we should miss to the high side for a while. And if you take that seriously, that means basically the price level should rise with some volatility around it, along a smooth trend, rising, say, at a 2% rate over time. So that doesn't sound that different, but let me convince you that it is different. So here's an example. So here, consider an economy with inflation target, that's the blue line. So inflation's going along, it's at 2, the central bank's happy, that's what they wanted. Then there's a recession, inflation falls to 1%. They provide a lot of monetary accommodation, the economy recovers, inflation moves back up to 2, and you just leave it there. On the other hand, if you have a price level target, if you don't let bygones be bygones, if you're going to make up for those past misses, this miss to the low side means you're not done when you get inflation back to 2. You've got to push inflation up to 3 for a while and then bring it back down to 2. And that has real consequences if people understand that that's the plan. Because in a deep recession, when monetary policy is constrained, inflation is going to run persistently below your target. And under price level targeting, the central bank's going to have to aim to get inflation not just back to target, but above it for a while. And that overshoot means that the central bank's going to keep rates lower for longer. So it's going to keep monetary policy easier for a longer time. That, just through the same mechanism as we talked about when we talked about forward guidance, it's going to lower long-term interest rates because the path of short-term rates is lower for longer. And inflation is going to be higher. So not only are long-term rates lower, but real long-term rates are even lower because inflation is going to be higher over the life of this, say, 10-year bond. And those lower long-term real interest rates are going to help to boost inflation, output, employment, all the things that you want to do. And those effects will happen soon because long rates fall now. Real long rates are lower now. And so when you're stuck at the lower bound, you get an extra boost from the lower longer-term interest rates and the higher expected inflation. So that potentially makes this sort of price level target pretty appealing. And a bunch of economists have said that they like this idea, including, at least to some extent, John Williams, the president of the New York Fed. But I think there are some significant drawbacks to this sort of policy. One obvious one is, well, what if there's just a temporary rise in inflation? So you're going along, output's near trend, inflation's near your target, and then there's an oil price shock or something like that. So inflation goes up for a little while. Then it comes back down again. It's not a permanent thing. It's just a temporary inflation shock. So the price level's now high. And so the central bank gets to the point where inflation has come back down to 2, output's near potential, and they say, but wait a minute, price level's too high. We've got to tighten monetary policy to get inflation down, to get the price level back down to where we want it. The example I showed earlier, but in reverse, where you get an inflation shock, and you've got to unwind it, you've got to offset it with a period of low inflation. So you may have to engineer a recession to get back to your desired price level target, when you didn't have to have one, and when inflation is actually pretty good. It was around 2%. Again, they're not going to thank you for that sort of policy. I think also the change in framework would just be really hard to communicate clearly and credibly to the public. They may not understand it. And in a paper with a couple of co-authors from the board, we show that if it's not understood, the results can be worse rather than better, because inflation expectations start to move around, you have to re-anchor inflation expectations. It can cause a range of problems. And just uncertainty, people don't get it. Maybe they start building in risk premium in asset markets, and that's not going to help either. So there are some less dramatic alternatives people have suggested. Ben Bernanke has suggested a half step. So temporary price level targeting only when you're stuck at the zero bound. That has some attractive features, at least in models, but man, it's going to make the communication problem really hard. You've got to say, well, we're inflation targeters, except sometimes when we're price level targeters. Ask us, we'll tell you. I think that's not going to be an easy thing to convey and make credible to the public. How about a quarter step? I think this is a little more plausible. You just say that persistent misses are going to make the central bank more willing to accept an overshoot in the other direction. And that might help, for example, reinforce forward guidance that you're going to be easy for quite a while. You say, well, that might mean that inflation goes up more than we intend. That's okay. We've missed to the low side for a while, and if we happen to overshoot, we're not going to worry too much about that. But that's really only a quarter step. Finally, You can dial it up to 11. I don't know how many people have seen Spinal Tap, one of my favorite movies. So dial it up to 11. Monetary fiscal cooperation, helicopter money, things like that. It's got lots of terms. So some former policymakers, somewhat surprisingly, so Adair Turner, who was the Chancellor of the Exchequer in the UK, Will Howard, who's on the board of the Bank of England, Jean Levin, who's at the Bank of Canada, Stan Fisher, who's Vice Chair of the board, Philip Hildebrand, who's on the board of the Swiss National Bank. They've all suggested that when monetary policy gets stuck, then there should be a shift to fiscal policy financed directly by the central bank, financed by money creation. And in theory, in a model, that can be really powerful. You're going to generate high inflation from the monetization of the debt. You're going to get a big fiscal kick, and that works very well. But again, it's going to be really hard to communicate. And it might be unsettling for investors. But this is how hyperinflations happen, literally. Right? And so I think it really could boost risk premiums and prove counterproductive. And the politics of it is hard. How do you manage this with an independent central bank? You probably can't, or at least it's hard. And that isn't necessarily a good thing either. All that being said, Japan has actually done something like this in recent years. The Bank of Japan has run a very accommodative monetary policy, including a commitment, as I said earlier, to keep the 10-year government bond yield near zero, and a commitment to overshoot their 2% inflation objective if they can ever get inflation up. So that really puts fiscal policy on sale. Right? The real interest rate on 10-year government debt is negative. And so you can tax less by delaying taxes for 10 years. Spend now, tax later. That created room for the fiscal authorities to do more than they otherwise would have, I think. And they needed that room because the debt to GDP ratio in Japan is over 200%. They've got a big national debt. And the combination seems to have had some useful effects, although the story is not yet run. As I said earlier, there are real issues around exit to the Bank of Japan. So let me just offer some conclusions. As central banks go into these reviews, I think they're right to review their monetary policy tools and frameworks. The lower bound on interest rates is here to stay. This is going to be a problem in downturns for some time. So you need to think through, what are the tools you have? What is the unconventional set of unconventional tools you have? And it's good now to think about, how are you going to respond to the next downturn? How will you deploy these tools? What's the escalation? What do you do first? What do you do then? Think hard about how you're going to communicate these things, because communication is clearly very important. Central banks should emphasize in these reviews that monetary policy isn't powerless when interest rates get to zero or whatever the lower bound is deemed to be in a particular economy. There are unconventional policies. They allow central banks to do a lot. And so they can do that, and so they should express confidence in those tools. And in addition, since now those tools have been tested, the uncertainties, the risks around them, proven to not be that serious, I think the central banks could be more aggressive in using them. So the next time there's a downturn, you can announce purchase programs and forward guidance more quickly and more effectively, and maybe front load a little bit more the effects of the unconventional policy relative to what we saw in the Great Recession. Changes to the monetary policy framework could help, but boy, they could also cause uncertainty and volatility, at least for a while. And so I think they may not be desirable, at least at this point. But at some stage, if interest rates continue to trend down, maybe that's something you want to think harder about. But I really wonder whether any of the central banks are going to sign up for something like that at this point. But it's going to be very interesting to see what the central banks decide, and it'll be very interesting to see if they disagree. And so we'll see how that comes out. The Fed is going to tell us this summer, and the ECB after that. To wait to learn more about it. Thanks very much.
We're going to have about
15 or so minutes for Q&A that's shared, and then, of course, as was mentioned in the invitation, we're going to have a reception afterwards. So if you don't get your question asked, Professor English is going to stay for the reception. Don't worry, you'll get a chance to try to ask your question afterwards. So here we go. Try to keep your questions short.
Thank you. Some would argue that most post-World War II recessions have come about as a result of rising inflation and Federal Reserve tightening, which has then led to a slowdown in a recession, and then, of course, a reversal of that policy to re-stimulate. If interest rates are going to stay low, as you believe that they are, you would think that unless inflation accelerates, importantly, that this expansion, which is already one of the longest, if not the longest on record, will continue, and that therefore equity markets and assets, particularly given the spreads, should continue to do reasonably well as an asset class. Is the expectation of no recession from a traditional source, is always the black swan issue, I mean, whether it be the coronavirus or something. But putting that aside, is it reasonable to expect that kind of continued growth in the economy with no recession?
Yeah, so you're quite right that at least some of the recessions in the U.S. post-war history reflected, in effect, monetary policy was too easy, allowed inflation to get high, and then monetary policy cracked down to beat inflation back down again. But not all of them. I mean, the recession in the early 90s, the recession in the early 2000s reflected just a range of factors that weren't really that inflation was too high. In the early 2000s, it was really a story about the boom and bust in tech stocks in particular, stock prices. So I think we still have, a bunch of possible sources of recession. These days, one that feels big, at least to me, is the global economy. So China has a very rickety financial sector. They could have some problems. If China has a big problem and Asia has a big problem, then the U.S. probably has a problem. So there are certainly global risks that could push the U.S. into a recession. And there are domestic financial risks that could emerge. So I think there are still risks that could generate recessions. But you're right, if monetary policy is better, then we should have fewer of them. And maybe they will be shallower. And indeed, just prior to the financial crisis, economists were talking a whole lot about the Great Moderation. From the mid-'80s to the 2007, the economy was pretty stable. Recessions were, there were only two, and they were pretty small relative to other post-war recessions. So I think that's kind of what you're pointing to, that if policy is better, then the economy should be more stable. I think that's right. But I don't think it's going to put recessions completely in the rearview mirror. There'll still be shocks that can happen that kick the economy into a recession.
Given that we have really low real rates on bonds, we have really low real rates on bonds,
yep,
and a relatively high stock market. If I'm a retiree, am I optimistic at this point for long-term income?
So I think it depends very much on what your portfolio was as rates came down, right? If you were holding equities and long bonds, then your wealth went up a lot.
Yeah.
And the fact that the return you're earning on that wealth is lower is okay, because you can still afford whatever retirement you like. It's a little tougher for people who hadn't yet saved a lot for retirement, and now they're looking at quite high asset prices and returns that are pretty low, and that means that they will need to accumulate more to retire, and that is a problem for some households that are just kind of entering their high saving years. And for some of them, that's kind of countered by you can borrow very cheaply now. So your mortgage has a lower interest rate, so that helps. But it hurts that you're earning a lower return on your IRA or 401k. And so it's certainly a mixed blessing.
I'd like to ask about one of the points you raised where you mentioned Japan 2-to-1 debt to GDP, and see how much attention has really been there, and really looking at the corporate sector too, where we've had a vast amount of corporate debt issued, and if I was a corporate treasurer, I'd be issuing as well. A lot of that's been used for stock buybacks as opposed to building the bank.
Sorry, and so the question is that a concern? Is that a financial stability risk?
How much attention's been put on that, or as a potential risk?
So it's certainly gotten a lot of attention. If you look at the financial stability reports that the board is now publishing twice a year, there's been a lot of focus on high levels of corporate debt. Corporate leverage is really high, so there are a lot of graphs showing debt-to-income ratios for households are still pretty low relative to where they were 10 years ago. But debt to output, sales, whatever ratios for businesses are really high. And kind of making that may make you feel bad. That can make you feel worse because a lot of that debt is pretty low quality debt. So low rated bonds and highly leveraged syndicated loans are a big piece of that debt. And that certainly is something that the Fed and other financial stability watchdogs are worried about. I think at this point, the sense is that those losses in a recession would be big. They're fairly well distributed. And so there'd be a lot of investors that would lose some money. But it's not a financial stability risk in the sense that you don't have, as we did before the financial crisis, highly leveraged intermediaries that were holding the risky debt and funding it with very short-term runnable liabilities. So there's been a lot of focus on who exactly is holding these risky credits and how are they financing them. And at least at the moment, it seems like these risks aren't all that large, but it's definitely something that's getting a lot of attention. And if you started to see, as we did pre-crisis, kind of heavily leveraged entities buying these risky debts and funding them short, I think the regulatory community would have to respond to that. Whether they would, I might doubt in the current environment. But they should, because that's exactly the juxtaposition of things that cause such problems.
Given what Japan's done, given what Japan's done over the last 30 years in terms of monetary, unconventional monetary policy, why is there still a question that unconventional monetary policy will increase inflation, because it hasn't?
So, my read of the Bank of Japan's actions is that up until 2013, they actually were not particularly aggressive, given the situation that they were in. They had a huge financial bubble and then a huge financial crisis in 1990. They had a banking crisis that was massive through the 1990s that it took a long time to deal with. By the time they kind of cleaned that up, the world was going into recession in the early 2000s. And all through this period, monetary policy, while easy, just wasn't easy enough. And really, it wasn't until 2013 that they kind of took the bull by the horns and said, gee, we've been trailing behind the problems in our economy for 20 years at that point. Under Prime Minister Abe, they took much more aggressive steps. The problem they've been having, there was actually a really nice piece in the New York Times, I think, in the last week or two about inflation expectations in Japan are now really, really low. You have a big chunk of the population has basically lived their entire adult lives in a world with no inflation. And so saying to them, yeah, we're going to get inflation up to 2, just is incredible. And so it's been very hard, I think, for the Bank of Japan to get traction with their inflation target. That said, they've provided a huge amount of stimulus, and the Japanese economy has actually performed well since 2013. Output is above potential. They've made a gigantic structural shift, a huge increase in female employment, a huge increase in employment of the elderly. Those sorts of structural shifts are really hard to make but they've had a very high-pressure labor market. They've managed to do that. But inflation has kind of stuck at a low level. This is not that bad an outcome, right? They're running a high-pressure economy with a labor market that's tight and people can get jobs, and inflation hasn't taken off. So I think, in some sense, the Bank of Japan should be pretty happy at how things have gone since 2013, and they should stick with it. And eventually, inflation will start to move up. Then they're going to have to tighten policy some, and output will fall a little towards potential. Unemployment will go up a little. It's really low now, and they'll have inflation that's higher and closer to their target. When that will happen, though, I don't know. Expectations seem really, really firmly anchored down close to zero, and so they haven't made a whole lot of progress. A little, but not a lot.
Last question.
Yeah, I'd be interested in your thoughts on sort of a side issue, global GDP growth. If I'm not mistaken, it's population growth and productivity which drive GDP growth. When you take a look at population, you've mentioned that population growth is slowing all over the world. It's flat to declining here, it's going down in China and Japan. Urbanization, China's become much more urban than it had been, and their economy grew from very small to second largest in the world. And then also, following up on that point, as you well know, China used to grow at 12, 13%, now they're growing at 6%. And I've seen the empty cities. They're a fact. And a lot of their growth, they have zero population growth, no productivity particularly. They're outsourcing to Vietnam and Bangladesh. So where's their growth going to come from? There's a lot of empty cities. A lot of their growth was building cities that they haven't been using. I was on a toll road for 45 minutes. I didn't see one car. And they spent a lot of money building it. So what are your thoughts on global growth? I'd like to be an optimist, but I see it declining materially.
Yeah, so I guess I would make a distinction between the China story and kind of the rest of the developing world. China had a period of just absolutely spectacular growth, and that can't go on forever, and it is not going on forever. Their growth is slowing. The key issue for China is, can they kind of manage that slower growth and the debt that they accumulated during that period of very rapid growth in a way that keeps their economy more or less on track. It's a slower growth rate, as you say. Or is there just a big fallout from that period of rapid growth and high debt? I guess one of the advantages of being a totalitarian state is you have a lot of tools. And they have a lot of tools that they'll use to try to keep the economy expanding at least a modest pace. But that's a risk to the global outlook, for sure. Something bad could happen in China. Now, outside of China, there are a bunch of other developing economies that aren't as far along as China, and where growth should continue to be pretty strong. Elsewhere in Asia, India was growing rapidly. Now they're slowing for a variety of reasons, but there's a lot of potential still in India. And so global growth is the sum of a lot of pieces. China's a big piece, and it's slowing. So maybe the global growth will be somewhat slower going forward than it was over the last 10 or 15 years. But nonetheless, I think there are enough other economies that are kind of early in their development story and can grow pretty quickly. You can still be a global growth optimist. Maybe not quite as optimistic as you were, but still a global growth optimist.